Hello, everyone. Thank you very much for joining us today. My name is Daharsh with Advanta IRA, and I am joined today by LaDonna Smith. Our topic for today's educational webinar is how joint venture investing works for fix and flip real estate. Again, I'm Daharsh. I've been with Advanta IRA since 2016. I spent a number of years as a client account manager processing our clients' day-to-day investment transactions. And then I actually moved in 2020 up to Western North Carolina, where I currently serve on the business development team, networking and providing education about these self-directed accounts and passing along my knowledge of the power that these accounts allow you to have when you're investing with your tax-sheltered money. If you'd like to reach out to me, my phone number and email address are right there for you, and you could always find me at advantaira.com or go ahead and check me out on LinkedIn or Facebook, Daharsh, CISP. I'd be happy to answer your questions and help however I can. Again, my guest today is LaDonna Smith. She is a co-founder of the Perfect Day Club. She has participated in over 300 single-family renovations and over 1,600 real estate transactions in general. She's been in the industry for over 10 years, has a lot of experience as a property manager, and just a lot of general experience in the real estate world. So she's a real wealth of knowledge. I'm very happy to have her today, helping us talk about joint venture investing, which is something that she's particular to, and actually is going to provide us a real-life case study today of a joint venture investment that she's recently completed. All of LaDonna's contact information is also here. You can reach out to her on those same channels and connect with her directly if you want to learn more about what she's doing or more about the Perfect Day Club. LaDonna, thank you very much. Anything I didn't say in your introduction that you'd like to add for the audience?
No, I think that covers it. I'm just happy to be here and share this particular way of doing real estate.
Awesome. Well, thank you very much. I know we're going to bring some great content to the audience. And for the audience, if you're participating live with us today, you are going to be muted through the duration of today's webinar, but we do encourage your participation. You can go ahead and drop your questions in the go to webinar question box. And I will ask those through to LaDonna as she's presenting. If they relate to her slides, anything that doesn't necessarily relate in the moment to the presentation, we'll hold and cover at the end. And also, if you're someone that would like a copy of today's slide deck, you can reach out to either of us and we will be happy to provide you a PDF version of the presentation. If you'd like to review the webinar in itself, you will receive a copy emailed to you tomorrow. If you have not signed up for this webinar, you can find it on YouTube within about a day of this live recording. So today's agenda, I'm going to cover the basics of self-directed investing, just a general overview of what self-directed investing is. Then I'm going to hone in a little bit further on partnering retirement funds for joint venture investing. I'm going to cover some of the IRS rules and feedback from Advanta IRA that you should be aware of as you're deciding how to structure and what type of joint venture investing you want to do. Then I'm going to hand over to LaDonna for her portion of the presentation. Again, she's going to cover a real world example of a joint venture investment she recently completed and give you some overview about her explanation of joint venture investing, how she does her structure, and some pros and cons and different information you should be aware of from a real life joint venture investor. Again, at the end, we'll cover any questions or concerns that you have during the presentation that we don't address as we're going naturally. So Advanta IRA is a self-directed IRA administrator. We have been in the industry for 20 years now. In 2023, we have just over 10,000 active clients that have just over $2 billion in assets under management. All of our clients' funds that are not actively invested are insured up to FDIC limits. And another thing that we do besides these educational webinars and our podcast and our blog to stand above other companies in the self-directed space is we pair each client we have with a dedicated client account manager. So you get concierge level white glove service for your self-directed investing. Again, I served about 5 years as that client account manager, so I'm very familiar with the service they offer and how we help you basically answer all your questions and structure your investments within the IRS's compliance so that you make your decision on what you want to invest into, and we help you make it as simple as possible to accomplish and execute that transaction. It is important to note that we do not provide any tax, legal, or financial advice at Advanta IRA. Everything that we're going to cover today is strictly for educational purposes. We always implore you to consult your own attorneys, CPAs, other financial advisors, or whoever you deem as part of your investment team before you make any investment. So always conduct your own due diligence. We're here to follow the IRS's rules and keep you on the right side of that. You're in a self-directed account supposed to be making all the direction for the types of deals and specific deals you want to invest into. Now, what is a self-directed IRA? Again, it's an account that allows you to make any investment you would like where you do not have a fiduciary or financial advisor overseeing what you do or do not invest into. The investment classes include real estate, like we're going to cover today, hard money lending, like issuing a mortgage or a private note to someone, private placement investments or limited partnership investments, also known as syndications, precious metals, foreign currency, futures and forex trading, and much, much more. You can definitely basically invest in anything you would like to with your tax sheltered retirement dollars, as long as it's not a life insurance policy or deemed a hard to value collectible by the IRS. Hard to value collectible, just a few examples. I'm talking about antiques, fine wine, artwork. Maybe you're a car collector and you think an old rusty convertible or Corvette is a great asset. The IRS doesn't necessarily see it that way. So those are the types of assets you cannot hold. Anything else, as I listed and show here on the screen, you can invest to. You just need to know how to structure it, which is what we're the experts in. There are a number of different plans that can be self-directed. Most people are familiar with your standard traditional and Roth IRAs, but we also offer plans for small business owners, which would be your SEP IRA, your simple IRA, and also our solo 401k plan. If you have a former employer plan that you've left or terminated employment, so let's talk a 401k, a 403b, a 457, a thrift savings plan. Those are funds that can easily be moved from the previous employer to a new self-direct account with no tax consequence and allow you to make these type of diverse and unique investments with your tax sheltered money. We also offer health savings and education savings accounts. If those are plans you're interested in, feel free to reach out and we'll be happy to speak with you about your needs, provide you an option or an opportunity to learn more about the plan type that would fit your needs best, and we'll help you through that process of onboarding and setting up the account as well. So now that you know what types of plans are offered, why do people choose to self-direct? Well, a key reason that people choose to switch over from their existing plan or a financial advisor plan to a self-directed account is because they're already doing some type of investment. Maybe you're already a joint venture investor. Maybe you're already a real estate investor or a hard money lender. And you learn that you can use your retirement dollars to make those same type of investments. Well, it's new capital for the strategies you're already building and understanding a knowledge base in. You may be stock market fatigued, thinking, oh, the fluctuation, I'm not really looking to ride these waves anymore. So whether it's a full switch over or just a diversification tool, getting some money off of the stock market and into more controlled assets like self-direction offers you is another reason a lot of people move. And then the third option, tax benefits. When you're making investments with your tax sheltered retirement account, you're either growing profits in a tax deferred capacity, meaning you do not pay taxes on the growth at the time that you're making the investment or at the time the investment plays any portion of proceeds back into your account, but you do have to pay taxes on the distribution later in life when you've retired and you start drawing on this money for your distribution retirement expenses. If you have a tax-free or a Roth account, all of the income you generate with these investments are completely tax-free, because you've already paid taxes at the onset or putting the money into that Roth IRA or Roth component 401k plan. So again, keep in mind, if you're real estate investing, these accounts are not subject to capital gains. They're just added as your ordinary earned income. When you distribute the funds later on in life, or if it's a Roth account, you never pay taxes on the earnings you generate with the account. Now I'm going to cover some pieces of the rules and regulations about these retirement accounts and how you can and cannot invest with them. I covered earlier the asset classes that are allowed and the simple basis of what types of assets you cannot invest into. The only other thing the IRS really does to restrict your investments is label some parties as disqualified persons from your retirement account making investments. So disqualified persons in general are your parents, your children, yourself, and your spouse. So that is to say, I cannot buy a piece of property with my parents or my children. If I own a piece of property, I cannot let my children rent it from my retirement account. I cannot buy or sell property I own personally with my retirement account. So those are the types of things that you should avoid. Having said that, you are able to partner, or in this case, potentially joint venture with your retirement funds and yourself or disqualified persons. I'm going to cover that a little bit more thoroughly in a few slides. So knowing how you can invest and who you can invest with is important. But again, finding the deal when you have a self-directed account is completely your responsibility, and investing with people you know and using your network is your best way to do that. Whether you're someone that's part of your local RIA group, you found groups on Meetup, or you found this educational content on our YouTube page or on our website, it's always important to grow your network, invest with people you know. That triad of know, like, trust is very, very important when you're putting your tax sheltered retirement dollar on the line to make these investments and hopefully build the best nest egg for your future self as possible. So again, covering some of the basics of partnering and joint venturing, a retirement account is allowed to partner on a deal with either individuals, LLCs, trusts, and even other retirement accounts. And the retirement account can partner with disqualified persons as long as the investment is made at the onset, where the ownership percentages are specifically outlined and everyone brings the appropriate share of the investment to the table. So if you're talking about a straight real estate investment, the deed of title should list everyone that's investing into the property at their ownership percentage based on the total dollar amounts they're bringing to the closing table. That's a little bit different with joint venture investing, which we'll cover in the next slide. But just in general, the partnership can be attained and it can be done with disqualified persons. You'll just want to look into structuring options like using an LLC or setting up a joint venture agreement, which we're focusing on in today's webinar. And even real estate investment trust can be another product and option for structuring these types of partnering investments. So some key considerations for joint venture investing: what value is each partner bringing to the table? When you're investing with your retirement account, you're not allowed to conduct sweat equity or manual labor yourself, because that's seen as a current benefit of your future earnings or your retirement account from the IRS's standpoint. So it's important to know that when you're joint venturing and you're using your retirement dollars, you're likely going to end up being just the cash bringer or the property securer, and you're going to partner with someone in most cases that's bringing some other equity, whether it's sweat equity or construction work or cash for renovations after the fact, or renovations they may be doing if you're partnering with a contractor. So make sure that you determine what role you're going to fill and what role your partners are going to fill as you're deciding how to set up this joint venture agreement. The other side of it is, how will the costs be handled and how will the profits be split? That's completely up to you as the investor. You control the joint venture terms and you execute the agreement between those by providing that agreement to Advanta, labeling it as read and approved that you've agreed to all the terms. We'll execute that for you on behalf of your retirement account. and enter that joint venture agreement with your partner so that you can have it structured and all agreed to in the terms you set as the self-direct client and your partner agrees to as the joint venture partner in this deal. So just a few simple basics. We can only receive the funds on behalf of the retirement account portion. So if you've got funds coming in or going out, depending on how that joint venture agreement's broken up, you'll need to have it set and understand that we're only able to pay out the portion that your IRA is responsible for. Your partner is going to have to maybe cut their own check or send out their own funds for expenses that come up if it's not handled in a different capacity. If you do end up holding on to a property, maybe it's a longer term than a fix and flip, and you hold it for rental income, we can only take in the income for your IRA's portion of the property. And again, we can only pay expenses. So the tenants may end up needing to send multiple checks, or you could structure something with a property manager or even set up an LLC that you invest into, as I alluded to on a previous slide there. Just general structuring, something to speak with your client account manager at Advanta with, and we'll help you understand the best ways to do it and fit your needs as best as possible. Partnering with yourself could be a gray area depending on, again, who is bringing what to the table in the partnership agreement. You may want to seek legal advice. We have some referral partners we can point you to if that's something you need assistance with, but otherwise consult your own legal professionals, and that is something you'll definitely want to do if you're interested in partnering with yourself. Now, the key takeaway points before I turn over to LaDonna that I want you to get from today's webinar is know, like, and trust is very important. Always conduct your own due diligence thoroughly. Again, you're ultimately in control when you're doing self-directed investing, so make sure you're fully confident in the investments you decide to invest into. No sweat equity is allowed. Your retirement account's the investor, not yourself as an individual. So keep in mind, you can't do anything now to benefit your retirement account, and these accounts are supposed to be generating passive income. So this strategy is separate from running your own flipping business or running your own real estate empire. You should be generating completely passive income. There are some areas where your passive income strategies may generate some active income, which in cases is okay. You just have to be aware of when you're in those scenarios and what type of tax you may need to apply for, or specifically have your CPA or tax preparer be aware of. Those are conversations, again, you'll have with your client account manager if you end up having an account with Advanta, and we'll guide you through to the best of our ability so that you're on the right side of the IRS's rules as it relates to these types of real estate investments. Now, having said that and covered everything from Advanta's end, I am very happy to turn over to LaDonna, who is going to cover from her side joint venture investing, again, with her own case study example and her own experience and expertise brought to the table. LaDonna, the floor is yours.
Thank you so much. I'm excited to do this. So I think you covered enough about me. I've been in real estate, I would say, all my adulting professional years. So started off in property management, worked for some REITs, worked for some local developers here in Florida, and did every type of property management there is, everything from Section 8 to Class A new construction. Another unique area that I had the opportunity to gain experience in was converting apartments to condominiums here in Southwest Florida. So I did that for a little while back before the last real estate correction. And then I got interested from there in, there's a lot of foreclosures around. There's a lot of houses sitting vacant. There's a lot of houses that needed work, and got into the real estate investment game, buying the houses, fixing them up, putting them back on the market. So I've been in and out of that game. I kind of ebb and flow. There'll be years where I'll do 20 houses in a year, and then there'll be years where I'll do 4. And then I also started working with a real estate education company, coaching and training their students on how to start a real estate business. So I've given presentations, I feel like in every city in the US, Mexico and Canada. So my passion is traveling. So it was a joy for me to be able to travel around the country, sharing real estate knowledge, helping people literally pursue their dreams. A lot of people, like, they want to get out of the rat race, they want to get out of the W-2, and they just needed some education on how to start, and I got to be a participant and help them do that. So feel free to reach out to me. BRRRR Holdings is one of my companies. It's an active real estate company that we use to buy and renovate properties currently here in Southwest Florida and also in Dayton, Ohio. Next slide. This, if you haven't heard of the term BRRRR, it's basically where you buy, renovate, rent, refinance, repeat. So it's the strategy I use when I'm looking to purchase a property that I want to keep as a rental. So this is a joint venture BRRRR project in Gulfport, Florida, and I'm very fond of Gulfport, Florida right now. It is a small town at the south tip of Pinellas County, St. Petersburg. St. Petersburg, Tampa area is one of the fastest growing metropolitan areas in Florida, and Florida is, everybody thinks Florida is growing, but it is one of the top. Jacksonville, Tampa, St. Pete, Orlando are one of the fastest growing metro areas in Florida. And I particularly like Gulfport because it's very low density. There's only a couple of high-rise condominiums. It's truly just a population of just over 12,000, but everything is either a walk or a bike ride to the beach. So you've got great proximity to water, which is why people are moving to Florida in general. The sunshine, the taxes, and being close to the beach. So this property, 4930 14th Ave South, is a two-bedroom, it's a two-bedroom, one-bath unit. So I was able, no, it's good, you can go ahead and go forward. I was able to purchase the property. I'm going to run through the numbers first and then kind of give you the background. I purchased the property for $335,000. The interiors were, both units were occupied, and I'll kind of talk about what I did with the renters of those. So most of the repair costs were to the exterior of the building. So we spent $7,585.44 upgrading the look of the property. And then my holding costs are actually negative $4,310. There should be a negative in front of that. I think the slide reformatted, but that's because the units were occupied when we purchased them, and we really had very little vacancy during the time frame that we held it. So we held the property whatever amount of time we had to refinance. So the BRRRR part is buy, renovate, rent, refinance. So we refinanced into long-term financing and got an appraisal of $455,000. So we were able to quickly raise the value of the property from $335,000 to $455,000. And you can go to the next slide. The $455,000 is just the appraised value. If we were to put this home on the market, or this duplex, it would probably easily sell, you know, just under $500,000. So the bank was comfortable doing an evaluation at $455,000, but if we wanted to actually flip it, I would have put it on the market for probably $485,000, $490,000, and there were comps that would support a closing of that price. So joint venture. How do I define a joint venture? A joint venture is just a business arrangement where two or more parties are pooling resources. So the resources could be, like Corey mentioned, sweat equity, it could be capital, it could be knowledge. And then we had a very specific goal we wanted to accomplish with this joint venture. So I partnered with a friend of mine from college. My partnership is I'm bringing the real estate experience. I'm here to find the property at the best, you know, below retail value. I don't like to pay retail for real estate. So I'm going to come in, I'm going to find a good deal, something that where we can force appreciation through renovation, and then I'm going to hire and manage the contracting team and then determine the best exit strategy. So the capital partner, they're bringing the money. So they're bringing the acquisition and the renovation costs, and then we're just meeting on a weekly basis on here's the progress of the property. So our goal is just to maximize returns. I want the highest cash on cash return for every dollar that's in the deal. Next slide. So this particular property, my home base is Naples, but I go back and forth now between St. Petersburg, technically Gulfport, and Naples. I was in Gulfport staying in a short-term rental. STR is just the abbreviation for short-term rental. I had 2 other projects that I was working on in the area, so I would go up and maybe stay a week or 2 weeks. Sometimes I'd stay a month, and I would book a furnished rental. This is before I had a place of my own. The host always likes to know, why are you here? What are you doing in the area? So I said, hey, I'm in town working on some renovation projects. And a lot of people find interest in that. You know, they're watching HGTV, so they want to know, like, well, what are you doing in my town? Tell me everything of what you're doing. So I'm like, well, stop by one day and I'll talk about what we're doing. So during my stay, she sent me a text like, hey, do you mind if I come by and, you know, just introduce myself? So she came by and we had a conversation, and Gulfport is a small town, and there have been a couple of times where I have met with a seller and I have to prove to them that I'm not an outsider. So another reason why I would go and stay is I could actually say, hey, I'm staying on 58th Street, or, you know, just to feel more local. They don't want someone coming from outside of the community and changing the community. It's a very beachy, artsy type of community. It has a very bungalow feel, and they don't want it to look like a suburban type of neighborhood. So she was curious about who I was, where I'm from, and why I was in her town buying properties in her town. So I think she got comfortable enough with me, and we were talking about one of the projects that I was doing as a renovation flip. And it just so happened, she's like, oh, my sister owns a duplex on that same street, on that same block. And I was like, that's fantastic. And I knew her renter. So this, I think, helped build my credibility a little bit more. I'm like, oh, is that where Miss Love lives? And she's like, yes, that's exactly where she lives. She goes, she's actually, my sister is interested in selling the duplex. She goes, I'll make the introduction for you. So she sent a text introduction to me and the sister, and pretty much that validated my existence with the sister, that I was, you know, I passed the sister test. So it was okay for the sister to talk to me about selling the duplex off market. So one thing when I was teaching how to build real estate, it was always be networking. Always talk to anybody and everybody. You never know who is going to bring you your next real estate deal. So I talked to her, I got that warm introduction, and it broke down the familiarity. I'm practically family now. And like I said, as I'm saying this, I say that because in this town, they're getting text messages from real estate investors and from wholesalers. They're getting cold calls. They're getting the "we buy your house." You've probably seen them, or you've probably received them, your letters, bandit signs, postcards. So everybody is getting that message. And getting a warm introduction from the sister went a lot further than a cold call or a text. Next slide. So I think it was a big factor in her only wanting to deal with me. So on this particular deal, my JV partner is a friend of mine from college. We've known each other for many, many years. He is the capital partner. Like I mentioned, I'm the real estate expert partner. So I'm bringing in that expertise and the sweat equity. Our structure for the property is 51% to him, the credit partner, and 49% to me, the real estate partner. He's 100% of the capital in the deal. And I will break that down on the number slide to show you the capital that we put in the deal to get it going, and then the capital he was able to get back out so we could rinse and repeat this. A couple of hurdles. There's always going to be hurdles during a closing. One was we needed to form a new LLC to purchase the property. And typically I can go to the Secretary of State's website in Florida and set up a new LLC, do a template operating agreement within a day. I don't know if COVID had something to do with it, but they were behind, and they were behind by 6 weeks. So we had to overcome that, setting up a new LLC. And then during the closing process, there was an unknown tax lien that was attached to my partner. He has a very common name. So it was an unknown tax lien in Arizona that we had to overcome so we could close the property. His name is David Johnson. So we had to first determine whether it was his tax lien or not, and then solve that problem before we could go to closing. So there's always something that needs, I would love it when a closing goes super smooth and you just sign paperwork, but there always feels like there's something that needs to be resolved. So those are a couple of the hurdles we had to overcome: establishing an LLC in the time frame we needed to, and solving for a common name tax lien. Next slide.
And LaDonna, I just want to add real quick, that LLC structure or setup timeline is not exclusive to Florida where LaDonna's operating. That could be the case in any state that you are in. At Advanta, we deal with a lot of clients that set up LLCs for their investments, and we've seen it in any state you can think of where the secretary or the entity that you reach out to register, whether it's SunBiz in Florida or wherever you're at, does tend to get delayed, typically towards the end of the calendar year. I remember last year there was a lot of Georgia-based clients that were having a 2 to 3 week delay on setting up LLCs in the state of Georgia. So if that's something you're interested in doing, make sure you get those balls rolling a little bit ahead of time, or just think proactively in that you could be struck in with a delay if you're on a tight timeline. Also, I wanted to add for the audience, please keep in mind, as I mentioned earlier, we do want your participation. You should have a panel from GoToWebinar, and in that panel, there is a box labeled questions. You can go ahead and add your questions there. I will ask them to LaDonna as they relate to her slides. If any questions do not relate, we will go ahead and address those at the end of the presentation. I'll go ahead and flip the slide and turn it back over to you, LaDonna.
And hey, Corey, something that I did after having that experience of a delay is I went and set up 2 LLCs in Florida. I think it's $139, just so I had spare LLCs coming into this year in case I needed to, quickly activate one again. Because sometimes when I'm making an offer on a property, a quick close is one of the terms that a seller likes. And so I want to have a couple of LLCs ready to go, that we can just amend who the managers are or partners, and at least have something established. So that's how I'm overcoming that for anything that I might encounter this year.
And that is a great point. Just to add to that real quick, if you're a retirement account investor and hearing LaDonna outline that of setting up the LLCs ahead of time and just having them ready, that is allowable for retirement account investing. It is important to note that LLC cannot have served any prior purpose to you wanting to use it with your retirement account. So if you're going to do something like that, set them up and leave them idle. Do not use them for any purpose. Just have it ready to go so you can mobilize it when you do have the deal or you are ready to use it. So that is just specific for those of us that are looking into and learning more about retirement investing specifically. If you have other purposes, go ahead and set those up and have them ready to go for those purposes as well. Thanks for that, LaDonna. I will mute myself now.
That's okay, great. So on the front end, purchasing the property, the 335 acquisition, I used a hard money lender. They are asset-based lenders. They funded 83% of the purchase and 100% of the renovation. And their rates are 9.24 and 2 points on a 6-month note. On the back end, on the refinance, we went with a debt service coverage ratio loan. And I'll show you in a second how we were able to get most of the money out. But my partner funded the money up front. And then the back end, he actually got money back, so there wasn't any second funding. But you can go to the next slide. So we use hard money lenders up front. Again, we're trying to put as little capital in each deal as possible so we can do more deals. So when we purchased the property, the 335, the initial capital was $71,210.96. That was the gap funding between what the hard money lender was loaning us and what was necessary to close. So my capital partner put in the $71,210.96 from his IRA account. You can go to the next slide. Before, each renter on each side was renting the units at $900 each, which was very below market. One tenant, she was on month to month, and so I had a conversation with her pretty immediately that I was going to raise her rents. I would work with her. I offered her to stay first, but at this new rent, and if she couldn't stay, which I didn't think she was going to be able to afford the new rent, I offered to work with her on a move out plan. So I think I let her stay there. She did not afford the new rent. I let her stay there another 60 days while she found places to live. But again, I'm just really kind of trying to keep things in my 6-month initial hard money loan term. The other tenant was receiving public housing from Pinellas County. Pinellas County was paying $1,050. Well, that was the rent. That was the total rent. I think they were paying $781. She paid the balance. But you can go to the next slide. So we put the improvements in, we paint, we put in, I mean, literally the paint job made it look like, we made the roof look newer, but we put in new paint, we put in new sod. I just cleaned the property up. The interiors, they already had hardwood floors. They were fairly decently upgraded. So this is the unit, the pictures, the interior pictures are the unit of the renter who left. Once she left, I re-rented that unit for $1,800 a month. So 2-bedroom, 1 bath. So we went from $900 to $1,800. You can go to the next slide. The other renter, we actually, Section 8 has an annual inspection, and I failed the annual inspection. They're very particular about what they require, and I had like a window that needed to be replaced. So I failed the inspection. I had to do these repairs. I ended up doing about $2,000 worth of repairs. But because we didn't get them done in time, this was towards the end of last year, it was the holidays, they canceled the lease. So they canceled the lease that they were paying $1,050 for. So once I completed the repairs, I had to fill out an application to renew the current tenant. And they asked me, what rent do you want? And I replied $1,400. And so now Pinellas County is paying $1,400 for that other unit. So I had to evict, in this short period of time, I had to evict the girl who was paying $1,800. I re-rented it for $1,785, and the housing unit's now rented at $1,400. So when we refinanced, again, the property appraised for $455,000. We were able to replace the hard money loan with the long-term DSCR loan. We were able to get $67,357 back of the original $71,000. So now we have $3,853 of capital in this deal. So we're controlling a property that's valued at $455,000 with $3,853. So our goal is always to get as much money out of the property as possible. And we do that through the BRRRR strategy by increasing the appraised value, increasing the rents. The DSCR loan did an appraisal as well, but they're also more concerned that the debt is covered by the rent. So me raising the rents was important to getting the DSCR loan. So we have $38,000, $200 in rent with $3,853 in capital. Next slide. So that's my favorite part, is my game is to try and get, control these properties with as little money as possible. So yeah, so new appraised value of $455. Again, appraised value and market value. I'm here to tell you the bankers are being very conservative with appraised values. This property would easily sell for $485, but the bank wanted to be conservative on the appraised value and the loan, so they have a lower loan to value. So the bank appraised value is $455, but that is not the market value of the property. So the takeaways, you can go ahead and, as always, be networking, talk to everyone. When there's obstacles, and there will be obstacles, figure it out. There's my team, we always joke that we have plan A, but there's 26 letters in the alphabet. So let's just keep going until we run out of letters. And then control as much real estate as possible. We like to play real life Monopoly. That literally was a little greenhouse, and trying to get as many houses under control with as little capital as possible. And then have fun along the way. So any questions or any feedback, Corey, what do you think?
Yeah, LaDonna, I think that this has been great, not only for retirement account investors, but also just the general investor looking into joint venture strategies. And as you said, building that real estate empire as they learn more and grow. So it's been very resourceful and helpful. I believe so. We do have a few questions in from the audience. I saw someone just use the hand raise feature. Please, if you're the person raising your hand, go ahead and jot your question down into the question box. I'm going to address those here as we go until I stop seeing them come in, and then we'll wrap up and conclude the webinar. So the first question that came in, someone was asking if you have a website to point them to. I believe they tried to search BRRRR Holdings as its own website and weren't sure if that pulled up properly or not.
Yeah, I don't have a website. The best, I'm going to give you a website, but I can tell you I haven't updated it in a couple of years. I have another company called Sharper Home Solutions. I don't know. I personally don't have a lot of value in a website. Kind of like I mentioned in this webinar, me getting the properties at the prices I want has to be a relationship based. And so it's me talking to sellers, me solving problems that sellers have, whether it's financial. I'm buying a property this week from a couple who they're headed to assisted living and they have some significant medical bills. So we're solving their financial medical bill problems by buying this property. But yeah, I don't have a website for BRRRR Holdings. That is just basically my active real estate company, one of them.
So, yep. So in other words, email, call, look up LaDonna on Facebook as she has contact info listed here, and connect with her directly one-to-one. That's, again, usually the best way to make that interpersonal relationship and connection anyway. So I definitely implore you all to reach out to her by those channels. Next question here. What kind of common pitfalls to be on the lookout for if you have never done a JV where one partner brings the deal, the other partner is the rehabber?
I would say just have a very, very clear joint venture agreement on who is doing what. Like my joint venture agreement is very specific on that I am the decision maker up to a certain number. And then once, like, let's say we have to make a decision and it's a $2,500 decision, I will consult with my joint venture partner. I will give a recommendation on here's what I think we should do, but I'm literally responsible for the day-to-day operations because I have done so many rehabs. So I would say have a very, very clear joint venture agreement on who's responsible for what, whether it's profits, losses. We have sale, like we work out 7 years of what we plan to do with the property. So we work that out in advance because you don't want to work it out when someone's in an emotional state. So like our goal is to hold this property for 7 years. If someone wanted to sell it before then, we have verbiage in our joint venture agreement about what happens if somebody wants to sell before the 7-year mark. So clarity, lots of clarity.
And just to expand on that a little bit, LaDonna, from my experience on Advanta's account management team, I've seen these joint venture agreements be very loose and kind of fly by the seat of the pants. And then I've also seen very detailed and very specifically, very detail-oriented agreements as well. And it sounds like even in your position, having mentioned that your partner is someone you've known for a long time and have a lot of comfortability with, I guess I'm just trying to get at, it's very worth it to have an actual attorney work with you to draw up these agreements and have something that's all but ironclad as far as who's doing what in any context. If there's any turn in the future, you have a resolution or you have something outlined in that agreement that's going to handle whatever avenue you end up in on this joint venture deal. So it's very important that you do have something like that from an investor standpoint. And really, when you're thinking about the overall cost of an attorney's maybe few hours of time to help you put together that type of document, that's going to well be worth it if you otherwise don't and end up in some sort of pitfall with your joint venture partner and you have other legal expenses to kind of go down the negative route on that side.
I concur. I've had a joint venture agreement that didn't go as planned. You know, you do enough of these, sometimes they don't go as planned, but the contract really kind of spelled out exactly what the expectations, what would happen. There really wasn't much to argue or debate because we had a pretty clear joint venture agreement.
Wonderful. All right, the next question here. Is there a way to structure a joint venture to do with private lending with multiple lenders? I'm thinking the JV would make the process for the borrower easier. If so, would the JV need a bank account if not all lenders are using SDIRAs? So from the SDIRA standpoint, I do want to just include or interject that anytime you're doing real estate investing and financing is involved, and a retirement account, specifically an IRA, is going to be in the deal as an owner, the terms of the lending involved, even if the retirement account is not a borrower, must be non-recourse terms. That in itself is its own topic that we cover on our website and in their own special webinars for non-recourse lending. But to the person that posed that question, I just want to make sure you're aware when you're talking about financing and you're talking about ownership in the name of an SDIRA, that financing is going to need to be non-recourse. Now, if you're structuring the deal as a joint venture deal, maybe the IRA is not going to be on the deed of title on the property, so that's kind of a moot point, everything I just explained, but it is an important topic to make sure I at least outline briefly. Getting back to LaDonna directly, do you have any input on the structuring when multiple lenders could be involved?
I mean, with multiple lenders, it's tough because everybody needs to be in their own lien position if they're a lender. So it can be done. Again, I'd get a good attorney involved. I've done properties where I've had 3 lien positions because I had 3 different lenders. You can't pool the money, so you can't pull everybody into one position. You just have to be very clear on who, everybody needs to know what position they are. You know, the first needs to know that there's a second and a third. The second and third need to know what position they are and that they're behind a first. And, you know, the risks that come with being a second or third lien position. Again, it has to be a crystal clear contract and it has to be a lot of clarity and it can't be pooled funds.
Perfect. And there's a question that somewhat relates to my explanation on that last question. Does UBIT tax happen with a JV deal like this where money is borrowed? So UBIT does apply when a retirement account is in the deal. And again, depending on how it's structured, a specific facet of UBIT known as UDFI or unrelated debt financed income is the specific tax that would apply. And that tax is basically levied on the percentage of the property or percentage of the deal that is being financed. So again, for the person asking those questions about UBIT or UDFI, you can reach out to me directly and I can give you some great resources on those topics. But we're going to really try to focus on joint venture in general today, not go down the weeds of the specific tax that could apply in those scenarios. Back to the next question for LaDonna. How do you de-risk increases in flood insurance and other costs?
So flood, well, the best way to de-risk flood insurance is know what zone you're buying in before you buy it. So that particular property, for example, is an evacuation zone D. It's a no to low risk flood zone, and that's not going to change. So that, well, does that mean my insurance will go up? It still could because I'm in Florida and we just went through a horrific hurricane and everybody's getting a new insurance bill. But I would start with where you buy. I actually walked away from a property last week that was on a canal because, not so much because of the insurance, but because the permitting has changed on this is in Pinellas County as well, on what can be done. And so the permitting process just recently got far more difficult, which means it was going to take a lot more time, which means a lot more money in the deal. So I decided to walk away. So I probably in the near future will not be doing any canal homes just because it's going to change the permit process and I'm not interested in the time and the hoops it's going to take to get through those. But I would start off just buying in non-flood, know your evacuation zones. Like evacuation zone A means you're waterfront, you're out of there first, or you're in a trailer. And that also means your insurance is going to be higher. So one of the first things I look on a property appraiser's website is what evacuation zone am I in?
Perfect. Next question, based on the loan you secured and incoming rent, what are you seeing as a monthly positive net gain?
That's an excellent question that I don't know 100% the answer to, because like I said, I had to re-rent the unit. I had to spend $2,000. So I haven't had a steady rental month yet, but my guess is we're probably net from taxes, insurance, principal, and interest, probably $600.
Okay. And the next question, feel free to address if you'd like to take this one offline. Do you have a sample JV template to share for a beginner? That may be something, obviously, that person, you may just want to reach out to you one-to-one.
Yeah, I would say I can give you a sample of mine, but I would recommend not to use mine, to have your attorney draft yours, because your attorney is going to be the one who has to defend it, and they like to defend their own work.
And that's a great point. Having something that not only just to have a piece of paper to say, oh, this is the terms, but if you ever are in a situation where they come to play in a legal perspective, making sure you have that person that's willing to stand and defend what's written out there. I agree with you there wholeheartedly.
Oh yeah, I forget what, I mean, contracts is kind of the nuts and bolts of everything that I do on a daily basis, whether it's contracts with contractors, real estate, sales, everything's a contract. And I have piecemealed a contract before together that my attorney I will never do it again. He's like, LaDonna, this is terrible. I'm like, I know, well, but I just needed it fast. So I will take the time and have my attorney either construct, review, or complete any contract that I use going forward.
All right. And there's two last items right now in the question box. So this is going to be my last call verbally for anyone that wants to add questions. I'm going to read through these last two, and if nothing new comes in, we'll go ahead and close out today's webinar. Someone said they were in a meeting that ran late and had signed in late. Any chance they can get a copy of the recording? To that individual, yes. The recording will be on our YouTube page within about 24 hours. And also, you should receive an email with a link to the recording from today's webinar within the next 24 hours from Advanta IRA. As I mentioned at the top of the call also, if you're interested in a PDF version of today's slide deck, you can either email myself or LaDonna, and we're happy to share that with the audience today. The next item, which is the final item, your opinion of a real estate deal with multiple investors like Lifestyles Unlimited, which does mostly rehab apartment buildings. They are mostly in Texas. So I think this person's just asking if you have an opinion of a specific group titled Lifestyles Unlimited. I'm not familiar with that group. LaDonna, are you familiar? And
I'm
do you
not
have
familiar
any
with that
feedback?
group either.
Okay.
I
Yeah.
mean, it sounds like maybe it's a syndication, and look at their numbers and look at their experience, especially with syndication. I would work with someone who has been setting up syndications more than the last 3 or 5 years, because some of the ones that I've seen out there lately could be in a world of hurt if they're not in the right market. So I would just look at their experience.
Yep. So yeah, for that individual, sorry, we are not familiar with Lifestyles Unlimited. If it is a syndication group, again, do your due diligence thoroughly. Make sure that your investment position fits the needs that you have, whether it's cash flow or long-term growth, and just that you, again, cycle back to that know, like, trust of the general partnership team that Lifestyle Partners is comprised of, or Lifestyle Unlimited. Final one came in, and we will close after this one. The percentage split, and this is referring to your joint venture deal that you showed us today, LaDonna. The percentage split also applied to the cash flow when it sells in 7 years. I believe the answer would be yes there. So that 51-49 split is how the sale proceeds are going to be when the property sells on your full cycle deal.
Correct. So yeah, in our operating agreement, the SDIRA is 51% owner. My LLC is 49. It applies to everything. It applies to income coming in now. It applies to expenses. It'll apply to the equity split on the back end. So if there's $400,000 of equity, they're getting 51. I'm getting 49.
All right. That person said thank you. So With that, we're going to close out today's webinar. Thank you everyone for participating with us live today. If you are not live and you're reviewing the recording, again, thank you as well. Please share this with any friends, family members, business colleagues that you think could benefit from learning more about joint venture investing. Please reach out to myself if you have questions about retirement account investing or learning how to set up an account to use your tax sheltered money in these types of deals. And reach out to LaDonna if you want to learn more about what she's got going on, whether it be her joint venture structures or her general real estate investment knowledge and expertise. We'll both be happy to help you however we can. LaDonna, any final words for the audience as we part ways?
No, I think I have found in these joint ventures, using the custodian, they're super helpful. Like, don't try and figure it out. Ask questions. You will get the right answer, especially when we're talking about, structuring deals with IRA accounts. Don't make guesses. Ask your person what you should do.
All right. Well, thank you so much for working on this with me. I very much appreciate your time, your effort, your expertise, and your energy. And we will see everyone next time. Thank you all so much.
Thank you for having me.